What is up, ladies and gentlemen, in the UMortgage universe and outside the UMortgage universe? Coming to you live this morning with the Monday market update. My name is Sean Grapevine. I am the director of Agent Direct here at UMortgage in our Atlanta studios, and I am lucky enough this week, as with most weeks, to be joined with the Mac of the Rate Stack, the guy who has his bips for breakfast, the one who does best efforts with no effort. He's the Baron of Bips. He's the Lord of the Locks. He's the Sultan of SLAs. Needing only to keep his core warm, the Viceroy of Vests maneuvers expertly about, arms flailing, locking loans, and signing on new lenders at lightning speed. He's the king of collateralized debt. He's the Colossus of credit. His name is the awesome Austin Jacob Koenig. Welcome, Austin.
Thank you, Sean. Thank you, Sean. New. This is why I'm not going to tell you any sort of nicknames or anything like that because you come up with your own. So we're talking behind the scenes in the green room.
Oh yeah, the green room. Yeah, we just polished off the last of the champagne when we had this
Yeah,
conversation.
exactly. So it's big wigs, and the big media. That's who we are. But
Mhm.
it's obviously great joining you again. The last one for October. This year's flying by. We got a good amount to talk about, so why don't we just get right into it?
Yeah, let's dive in. We've got once again last week, some good news for the economy, some good news for rate doves, and ended up from a fixed income point of view, fixed income market point of view, kind of being a bit of a nothing burger as we
Yeah.
had things going in opposite directions. So we had GDP on one hand, we have PCE on the other, and then various other sort of more minor players in the game. Let's go into this headline GDP number, 4.9%. I mean, that's like China circa 2013. I mean, that's like you may as well be making it up. It's a huge number, isn't it?
Yeah, it's definitely a big number. It was bigger than expected by a little bit, and at the same time, what I would say too is it's a story of resiliency. At the end of the day, despite the headwinds of expensive money, which the Fed has made money expensive, there's still investment, there's still spending, there's all that stuff is holding strong, and the economy is showing a measurable growth. Um, it comes at a time too where we have to also compare ourselves to other economies, and that'll continue to kind of go forward, something that we'll be constantly looking at. But the PCE number was also a number that came out too that we coincide like that with, and what that actually was holding like a pretty good level. It was not terrible by any means. So it was a good economic print week last week, I would say, for the kind of the soft landing types, right? If anything. So that all is a precursor for the Fed meeting this week, which is as always always kind of big headlines, big drama, and we can get right into that one as well. We don't expect any sort of rate hike necessarily,
Uh-huh.
but this
Good.
still could be on the table. We can't rule it out completely,
Do, do,
but
you, do you have the percent chance pulled up there on the
I don't have the
Lumi?
percent chance right in front of me, but it's been maneuvering. Like I would say, what's to pay attention to is kind of just will it happen before the end of the year, which is this hike, this meeting of their last, and it's still a little bit in the coin flip like arena, I guess you could say, but I think we'll get a better depiction after this meeting. Let's say if they do hike rates, there's probably no way they do it again, and lastly, if they decide not to hike rates, their messaging after the press conference and during the press conference after the meeting will be pretty important to pay attention to, and that'll also mean the Fed minutes that get released, a couple weeks after. Those will be really scrutinized as well, no question about it. So those are things that can move markets. If you are waiting to lock a loan, I would not wait for the Fed. Just kind of take it as it is, what you have right now.
Yeah, I
It
mean,
could be so many different
if
ways.
they elect not to to hike, which it seems like the market's pretty much priced in that we're going to see what we always see. We're going to see. I would say, here's my prediction. Bold prediction. I've been doing this for a while now. I would say 10-year dips to 4.81 until about maybe into the next morning, and then resumes. It starts today back at 4.9, guaranteed. You heard it here first.
Hmm.
I can guarantee it. You can. I'll collect my dollars from you at Winners on Thursday morning once 10-year hits 4.9. Yeah, so I would certainly. We have seen that the Fed has telegraphed their next move so well because of how badly it bit them in sort of the early days of like them having to be super responsive. And we saw these huge, massive spikes going one direction or the other, only to kind of settle at like a right where it started, basically. That they, chances of them hiking on this. I mean, it would hurt markets pretty bad if they decided to hike on Wednesday. I would think that taking people by surprise is not well liked at this point. So one of the things that Jerome Powell has said recently, so skipping forward to right, like we said, we had huge GDP. That's not great if you want rates to go down. We had pretty good, a lower reading on PCE. We're down in the mid threes on core and non-core PCE, which is like not the worst thing in the world. It seems to be kind of close to where we want it to be. And we've got Mr. Powell and his cronies making some decisions for us on Wednesday as far as the rates. And one of the things that he's mentioned about why they might not have to raise rates. And I'm not sure if this is like they need a good excuse not to, like they want to couch it in some like slightly more dense language. One of the reasons they've used is because the term premium in the markets is doing the job of what a rate hike would do. And so they don't feel like they have to intervene if the market is kind of doing it itself. Can you explain to me, like I'm a fifth grader, what the term premium is?
Well, it kind of, in a way, think about it like just you're sitting back in the mortgage seat, right? So every day, mortgage rates are kind of changing a little bit, right? Like, you quote a borrower one day, like let's say you quoted them 2 weeks ago, and what they get quoted today could be very similar, but the market could also change. And nothing necessarily fundamentally changed about the borrower, right? Like it's just a matter of the rate market. Because we face a market that is constantly moving and being traded. So the thing is that the rates are higher right now. And think about it like this, that same borrower, they didn't get a pay raise over the past 2 weeks. So maybe their budget, might have decreased if rates went up by, 50 bips on their mortgage rate, for example, right? They didn't want to pay any points, it went from 7.5 to 7.75, right? Their payment has also gone up, so their affordability has kind of come down. It kind of like, you know, haltering their ability to spend the money that they're
Uh-huh,
approved for.
uh-huh.
So in a way that kind of affects not only, you and our microenvironment of mortgages, it affects everywhere. Think about, businesses looking for loans to fund their operations.
Mhm.
Think of just the corporate bond market. That anything that the U.S. Treasury is trading at impacts that because that kind of was always denoted at, the U.S. Treasury rate that it's similar term as, plus a credit spread. And so the way that you know that market works essentially is making debt more expensive without the Fed necessarily doing a equal action. Of course, the way that rate market's gotten to this point is by multiple Fed hikes and no quantitative easing, right? It's
Mhm.
quantitative tightening. The Fed's not going
Mhm.
to buy bonds, printing money, nothing like that. They're in fact just unwinding their books. So they're kind of becoming, in a way, they're just stepping out of the market altogether. So these are the things that kind of affect the market altogether. It's just that's what it is. It's making money more expensive, and the Fed's not having to do it. They're not having to drag the bond market up. The bond market's already up
Right.
for them.
It's kind of like a positive feedback loop. Like is an example of this, the fact that rates are this high means nobody wants to buy mortgage bonds because they're afraid of the repurchase or the early payoff risk, essentially. And then that drives mortgage prices down even more. Like it's just like this, like everything's kind of adding to the fact that like once you get up here, like it's easy for it to just trickle up, essentially. And
The
that's
more
mimicking what a Fed rate hike would do.
the mortgage market is its own unique little animal, to be honest
Mhm.
with you. Um, with that, without trying to get too complicated about, how negative convexity works and duration risk and prepays, yeah, like there is obviously some lack of appetite at these high rates. Um, but at the end of the day, what's kind of happening in the Fed world is, yeah, like the the U.S. Treasuries are being traded, and they're being traded, with higher yields, and these yields are, enough to where the Fed feels like they're restrictive enough on the general economy, from a price pressure standpoint. So the money isn't too cheap right now, based off of how the secondary market is trading it. This is actually something that really could have been kind of the opposite way if, let's say, for example, how we reacted to the Russia-Ukraine conflict initially, yields came down dramatically. Um, that did not happen with the current conflict we have in the Middle East, right? In fact, it was barely a blip on the radar in terms of the
Mhm.
bond market, right? So those things, are actually good for the Fed because they don't have to like re-drag that yield up to make it in a restrictive territory. In
Mhm.
fact, it's almost kind of the Fed saying higher for longer means right about right here is what we're comfortable with. And if we don't need a hike to keep it up in this range, we don't necessarily feel the need to. It's also encouraging that they can, see economic numbers at this level, with what the third quarter printed with. But at the same time, the rates have been the highest they've been just now in Q4. So, when we're looking at great GDP data, that's
Right. It's like, yeah,
yeah,
June was a different, yeah, or I
yeah,
guess
July.
July
Yeah, what
was
was July
different.
like? Exactly.
No, nobody remembers. Yeah.
Yeah.
Yeah. I think we were just kind of starting to lament the 10-year hitting 4, and now we're sat with it at 5. So definitely an eon ago by our standards. So, all right. Well, we got the Fed this week. It sounds like there's low likelihood of a hike. And as far as actionable material for loan officers, well, several things, right? One is to be an expert in this, to read up on it. Don't just listen to this, 15-minute, obviously information packed 15 minutes, but also, educate yourself on this because buyers and real estate agents, like, they're going to be looking to you. Well, you're the expert. You deal in the fixed income market, whether you know it or not, and there's nobody in anybody's lives that's closer to this than you. So educate yourself on this. Be ready to have a conversation about it. Be ready to assuage concerns, and I mean, we don't want to sugarcoat anything, but to put context to what's happening. And then also, more than ever, uh, uh, if you like it, lock it. That's and actually, you know what? The 2023 mantra is, if you don't like it, lock it. There's really no other option. We got the best float down policy in the history of mortgages, which is they're called other lenders. And we don't want to burn our current lenders, but hey, if rates drop a bunch, we got to look out for the consumer. And if there's no float down or rate renegotiation possible, then we'll just move it, and that gives us all the power in the world. It keeps loans from going up, and keeps the downside open. Austin, any fun products or lenders coming on board in the next week or two?
Yeah, so actually, kind of promoting one thing that we had recently come out is the Loan Store, is a new lender we've had on. This is more for our Texas LOs. I mean, they do have a HELOC product that is, something hard to get in the Texas market.
Sure.
That's something to pay attention to. So definitely hit up our AE over there, as well as just, we have a lot of people going to the Winter Win event. I'll actually be there as well. So looking forward to seeing all of you guys, and we'll spend the Fed recap day together at the end of the day. So hopefully only good things, right? So that'll be fun, and looking forward to everyone being out there. So
Yeah,
obviously, safe travels.
Still time to register for Winners Win. I will
Yep.
be there. I'll be keynote speaking one of the mornings and holding a panel all about Agent Connect and reciprocal value and partnering with the people in your local market to really supercharge your your pipeline. So join us the second and third in Pontiac. Go to umortgage.com/winners-win and sign up. There's still plenty of time. Maybe you can get like a bargain basement deal on airfare and hotel. So thank you, Austin, as always, for a wonderful start to the week. I'm looking forward to seeing you in just over 48 hours. And guys, if you have any questions about how the market works, yeah, feel free to comment on this video. Tag Austin. I mean, tag me too, but just so I can see what the answer is and learn alongside with you. Tag Austin, and I'm sure he will illuminate and elucidate in a way only he can. Thank you, everybody. Thanks, Austin.
Of course. Thank you guys. Have a great week.